Good morning, dear students. Today we are going to start with problems on leasing and hire purchase. To begin with, we are going to start with problems on evaluating leasing. Okay, in leasing, basically problems are solved using two types or two viewpoints. One is from the lessee's viewpoint and another is from the lessor's viewpoint. In the theoretical classes, we have already studied who is a lessee and who is a lessor. Lessee is a person who takes the assets or goods on lease, and lessor is a person who is the owner of that particular asset or good. So with this, let's start with the first problem, that is problem number 2.51. I'll just read out the problem for you. The problem says XYZ Limited is in the business of manufacturing steel utensils. The firm is planning to diversify and add a new product line. The firm either can buy the required machinery or get it on lease. So they have two options. One is either buy the machinery, purchase the machinery outright, or to get it on lease. The machine can be purchased for 15 lakh. So they have said the machine can be purchased for 15 lakh. It is expected to have a useful life of 5 years. So they have given the useful life as 5 years with a salvage value of 1 lakh. That means they have given us the cost of the machine, that is 15 lakhs. Years, it has a useful life of 5 years, and salvage value is 1 lakh after the expiry of 5 years. That means it is the value at the end of 5 years. The purchase can be financed at 20% loan, repayable in 5 equal installments. So if you go for loan, then it can be financed through a loan of 20% interest rate of 20% per annum, which is repayable in 5 equal installments, inclusive of interest. So I'll just erase this off. Okay. Now, becoming due at the end of every year. Alternately, okay, so this is your details for your first option, that is buying option. Okay. Second is alternatively, the machine can be taken on year-end lease rentals. That means you can take it on lease basis. Now, what are the lease rentals? The lease rentals are 4,50,000 rupees for 5 years. Advise company on the option it should choose for your exercise. You may assume the following. Now they have given us some assumptions also. The machine will constitute, the first one is machine will constitute a separate block of depreciation purpose, for depreciation purpose. The company follows written down method of depreciation and the rate of depreciation given is 25%. Then the tax rate is 35% and cost of capital is 20%. Lease rentals are to be paid at the end of the year and maintenance expenses estimated at 30,000 per year are borne by the lessee. So this is what they have given to us. From this, we have to calculate what would be the best option, whether the lessee has to go for outright purchase of that particular machine or he should go for leasing. Okay. So let's start with this particular problem. Now, how do you go about this problem? We have to solve it using two ways. That is, first we have to solve it by leasing method. Another is by purchase method. So first let us go ahead with leasing. So under leasing alternative. Now what do we do under leasing alternative is, first we know that the lease rentals are uniform or they are same throughout the period of 5 years. So we directly take 1 to 5 years. Then lease rentals after tax. Now lease rentals after tax means it is 4,50,000, that is the lease rental which is given to us over here, into 1 minus t. We have already discussed after tax. If you want to calculate anything after tax, you have to multiply it by 1 minus t. T is the tax rate. So 4,50,000 into 1 minus 0.35, because tax rate is 35% given over here. So 4,50,000 into 1 minus 0.35, that is 4,50,000 into 0.65 gives you 2,92,500. So this is how you calculate first lease rental after tax. Now the question will be, why after tax? Why after tax? Because whenever you pay a lease rental, you save upon tax. It is a deductible expense. So you save tax on that. So whatever expenses you bear, that is the actual expense, but after tax expense would be less because you are saving that much of percentage of tax. So you have to calculate lease rentals after tax. Once you do that, then we have to find out the present value of annuity. Now the question is, why annuity? Why annuity? Because we are considering 1 to 5 years. All the years the installment is same or the lease rentals are same. So we can directly consider present value of annuity. Instead of considering each year, 1 year, 2 year, 3 year, 4 years separately, we can directly consider 1 to 5 years and directly consider here present value interest factor annuity, but it should be after tax. Now after tax means what? Your cost of capital, if you see, it is 20% given, which is before tax. Okay, you have to also calculate the cost of capital after tax. Now how do you calculate cost of capital after tax? It is 20% into 1 minus t. So 20% into 1 minus 0.35. So 20 into 0.65 gives you 13%. So your after tax cost of capital comes to 13%. Okay. So once we get this 13%, go to the present value interest factor annuity table. I am repeating, it is present value interest factor annuity table, and look for 13% for 5 years. So when you go to the table, 13% for 5 years will give you 3.517. So your annuity factor would be 3.517, and when you multiply 2,92,500 with 3.517, you get 10,28,723. So this is your final cost of leasing, that is 10,28,723. Okay, so this is how you do the calculation for leasing. So this is the calculation for leasing. Okay, I hope you are clear with this calculation. Next, let us go ahead with calculation of under buying alternative. Okay, so under buying alternative, first of all, when you buy, you are buying it by taking a loan. So you have to first thing that you need to calculate is, you need to know how much is the installment. So the calculation of installment, I have put it over here. If you see, okay, calculation of installment. Now how do you calculate installment? First of all, the loan that you are going to take is 15 lakh, because that is the value of the machine, 15 lakhs. Okay, then divided by present value interest factor annuity. This present value interest factor annuity for 20%, because cost of capital is 20% for 5 years. Okay, now here you don't take after tax, because after tax you are calculating it later. Okay, so here you don't take cost after tax. Fine. So first of all, this is how you calculate the installment, that is 15 lakhs divided by present value interest factor annuity at 20% for 5 years. So it is 15 lakhs divided by 2.991. Now how do you get this 2.991? Go to the present value interest factor annuity table. At 20%, look for 5 years. Okay, when you do that, you get 2.991 as the value. So use that value over here. Okay, so 15 lakhs divided by 2.991 gives you 5 lakh 1,505. So this 5 lakh 1,505 is your installment. This is the first calculation that you have to do when you are considering a outright purchase alternative. Okay, so installment is calculated. I hope you're clear with the calculation of installment. Now let us go back to the problem. Once we have calculated the installment, the table is very simple. First is year. So 1, 2, 3, 4, 5. 5 years is given. So 1, 2, 3, 4, 5. Then you consider installment. Now installment, we know that installment is constant or installment is fixed. So every year installment would be 5 lakh 1,500, 5 lakh 1,505, 5 lakh 1,505, 5 lakh 1,505 and so on. So it would be constant over there. Then is tax advantage. If you see here, it is mentioned as tax advantage. Now why tax advantage is because whenever you take a loan, you pay interest, and whenever you pay interest, interest is a deductible expense. So you save tax on that. So that is what is called as tax advantage on interest as well as on depreciation, because depreciation is also a deductible expense. So you can save tax on depreciation as well, and that is the reason why you need to calculate tax advantage on interest and depreciation. Now the question is, do we know the interest and depreciation? No, we have to calculate that. Now how do we calculate interest and depreciation? For that we have the working notes. So what is the working note? The first working note, if you see, it is for depreciation. Now this calculation we have already done in financial management, basic financial management, where I have told you how to calculate depreciation. So first we consider year, 1 year to 5 years. Then first is, what is the value of that machine? Value of that machine is 15 lakhs. Okay, so 15 lakhs, and depreciation for the depreciation percentage given is 25%. So what would be the depreciation for the first year? The depreciation for the first year is 15 lakhs into, okay, I'll just write it over here, 15 lakhs into 25%. So if you do this calculation, 15 lakhs into 25%, you get 3,75,000. That is your first year depreciation. Then you calculate written down value. Now how do you calculate written down value? Written down value is nothing but 15 lakhs minus depreciation for that year. That is 15 lakhs minus 3,75,000 gives you 11,25,000. So that is how you calculate written down value for the first year. Next, second year. Now second year depreciation would be calculated on the written down value. So 11,25,000 into 25% gives you 2,81,250. So how do you calculate written down value now? 11,25,000 minus 2,81,250 gives you 8,43,750. Third year depreciation would be on 8,43,750. So 8,43,750 into 25% gives you 2,10,973. Then how do you calculate written down value? It is 8,43,750 minus 2,10,937 gives you 6,32,831, and so on. You go on calculating depreciation for all the years. Okay, I hope this calculation of depreciation is clear. It is written down value. So always you go on deducting the depreciation, and on the remaining value you go on calculating depreciation for the next years. Next one is calculation of interest. So you have to prepare something called as a loan amortization schedule. That is your working note number 2. So how do you calculate loan amortization schedule? First is year, then is loan outstanding at the beginning. Okay, please remember, it is loan outstanding at the beginning. Okay, so how much is the loan outstanding at the beginning of the first year? It is 15 lakhs. You know the installment 5,01,505. We have already calculated it over here. So installment values are fixed for all the years. It's mentioned. Then calculate interest. Now how do you calculate interest? Interest is always calculated on the loan amount. So on 15 lakhs, what is the rate of interest? It is 20%. So on 15 lakhs, 20% gives you 3 lakh. Now you know the installment, you know the interest. Can you calculate the principal repayment? Yes. It is in this installment includes interest as well as principal. Okay. So out of this 5,01,505, 3 lakh is interest. That means remaining is the principal repayment. So how much is that remaining? That is 2,01,505. So installment minus interest will give you principal. I am repeating, installment minus interest will give you principal. Okay. Once you calculate the principal amount, the next thing that you need to calculate is calculation of loan outstanding at the end. Now loan outstanding at the end means whatever was the loan outstanding at the beginning minus, okay, minus the principal repayment. Okay, I am repeating. How do you calculate loan outstanding at the end? It is loan at the beginning of that year minus the principal repayment gives you loan outstanding at the end. So 15 lakhs minus 2,01,505 gives you 12,98,495. So this is how you calculate the loan at the end. Now loan at the end becomes the loan beginning for the second year. Installment remains the same. Interest is calculated on the loan outstanding at the beginning, that is 12,98,495. So 12,98,495 into 20% gives you 2,59,699. So that is how you calculate interest. So then installment amount minus interest will give you principal amount, and loan at the beginning minus principal gives you loan at the end. Once you get the loan at the end, the same value would be the loan at the beginning for the next year. Okay, so on that again installment remains the same. On that interest, so 10,56,681 into 20% gives you interest for that year. Then installment minus interest gives you principal, and loan at the beginning minus principal will give you loan at the end. So these are the calculations that you do for all the years. Now in last year what happens is, normally you have the loan at the end of the fourth year, that becomes the loan at the beginning of the fifth year. So the procedure remains the same. First you have the installment is fixed, which is 5,01,505. Now here you need not calculate interest first, because you know it is the last year. That means whatever is the loan amount, that itself has to be repaid. So the entire amount has to be paid. So principal would be whatever is your loan outstanding at the beginning of the last year, the same thing would be your principal repayment. And installment is 5 lakh, out of which principal repayment is 4,18,321. So interest is the balancing figure, that is 5,01,505. I'll just write it over here, 5,01,505 minus 4,18,321. Okay, this will give you the interest for last year. This calculation you have to do only for the last year. These calculations are not for all the years. All the years your calculation remains the same, that is installment, then you calculate interest, then you calculate installment minus interest is principal, and then loan outstanding at the beginning minus principal is loan outstanding at the end. But in the last year, the problem is this does not tally. Your interest or your principal will not tally. That is the reason why whatever is the loan outstanding at the beginning becomes the loan outstanding, the principal amount, and your loan outstanding at the end would be nil. Then whatever is your installment minus the principal amount, you have to calculate interest, or interest would be your balancing figure. Okay, this is for the last year. So now what we have done, we have calculated depreciation, we have calculated interest as well, because that is what we need to we have to calculate, if you remember. Okay, so once we do this, let us go ahead with the calculation over here, the main problem. Now if you see, we have taken interest but after tax. Now interest after tax means, if you see here, interest for the first year was 3 lakh, but here we have considered 1,05,000. Why 1,05,000? Because 3 lakh into 1 minus t. So 3 lakh into 1 minus 0.35, that is 35%. So 3 lakhs, okay, I'll just write it here, 3 lakhs into 1 minus 0.35. 1 minus 0.35 is 0.65. So 1 into 0.65 will give us 1,05,000. In the similar way, we have to calculate interest after tax for all the years. Okay, so this is your interest calculation, interest after tax. Next is calculation of depreciation after tax. So here we have the depreciation value 3,75,000, but that is before tax. How do you convert into after tax? It is 3,75,000 into 1 minus 0.35. That is 1 minus 0.6, 1 minus 0.6, 1 into 0.65, or sorry, 3,75,000 into 1 minus 0.35 is 3,75,000 into 0.65. So 3,75,000 into 0.65 gives you 1,31,250. So this is the way you calculate depreciation after tax. Okay, so I'll repeat. First you have to take the installment which you have already calculated. Then you take interest after tax. So you have calculated interest over here. Here you have calculated interest, and here you have to take interest after tax. So this is interest after tax. Then you have calculated depreciation here, but here you have to take depreciation after tax. So 3,75,000 into 1 minus t gives you 1,31,250. So once you calculate interest after tax and depreciation after tax, then you calculate the net cash flows. Now how do you calculate net cash flows? It is installment minus the total of these two, that is 1,05,000 plus 1,31,250 gives us 1,36,250. So 5,01,505 minus 1,36,250 gives us 2,65,255. So once you calculate that, okay, there's some, okay, it's 505, right? Yeah. So 2,65,255 gives us the net, that is the net cash flow. I'll just repeat the calculation here. It is installment amount minus interest and depreciation. So 5,01,505 minus 105,000, that is your interest after tax, minus 131,250, that is your depreciation after tax. So once you deduct these two values from the installment amount, you get the net cash flow, that is 2,65,255. This is how you calculate the net cash flows. I hope you're clear with the calculation of net cash flows now. In a similar way, do the calculation for all the years. Okay, then these are the net cash flows. Now we have to find out the present values of those net cash flows, because this is after 1 year, after 2 years, after 3 years, after 4 years, and after 5 years. But you have to find out the value at present. So what do? You take the present value interest factor. Now here you don't take lump sum. I am repeating, this is separate for each year. So you cannot take annuity. You have to take lump sum. Okay, so it is present value interest factor, the lump sum values. So go to the table, present value interest factor table for rupee 1. In that you have to consider 13%. Now why 13%? Because you have considered here cost of capital after tax. So here also you have to consider cost of capital after tax, that is 20% into 1 minus 0.35. So 20% into 1 minus 0.35 gives you 13%. So you have to find out the factors at 13%. So go to the present value interest factor lump sum table. See 13% and for first year, second year, third year, fourth year and fifth year. So you get the present value factors, multiply the net cash flow with the present value factors. So 2,65,255 into 0.885 gives you 2,34,751. 3,12,173 into 0.783 gives us 2,44,331. Okay, and so on, we get all the values. Once you calculate this, next you have to calculate the total of the present values of cash flows, that is 2,34,751 plus 2,44,431 plus 2,45,120 plus 2,40,589 plus 2,33,959. So once you do the total, you get 11,98,850. Okay, so this is the table. Then the last step is deduct or less. What you have to deduct? You have to deduct present value of salvage value. What now? In the problem, if you see, salvage value is given to us. If you just go up and check, okay, see here, the salvage value is 1 lakh, which is given to us. Okay, so you have to consider that salvage value and find out the present value of that. Why present value? Because the salvage value you are going to get it after 5 years. So you have to find out the value today. So you multiply it by present value interest factor lump sum. Okay, that is 0.543. That is your last year's lump sum factor. If you see, it's the last year lump sum factor. Okay, I'll just erase this and do it again. Okay, so 0.543 is nothing but the last year's present value factor, lump sum factor. So 1 lakh into 0.543 gives us 54,300. Okay, we have to deduct that, and then lastly we have to calculate the present value of tax savings on capital, short-term capital loss. Okay, now I'll just explain you one point over here. Okay, if it is a capital gain, then you have to add, but if it is a capital loss, then you have to deduct that tax, because whenever you incur a loss, okay, you are saving tax. Whenever you are incurring a loss, your tax is saved, so you have to deduct the tax whenever you incur a loss. Now how do you come to know whether it is a profit or a loss? Okay, please pay attention here. If you see the written down value of the asset at the end of the last year, it is 3,55,958. That means according to your books, the value of that particular asset is 3,55,958. But you are selling that asset for how much? For 1 lakh, because the salvage value is 1 lakh. So value as per you is 3,55,958, but you will be selling it for 1 lakh. That means you are incurring a loss of it would be 2,55,158. Now 2,55,158. Okay, I have not done that calculation, just I'll do it here. Please pay attention. So 3,55,958 minus 1 lakh gives us 2,55,000. Okay, not this, 2,55,958. Now this into how much tax are you saving? 35%. So into 35% gives us 89,585. Okay, so this calculation is 89,585. Okay, 89,585. Now how did I get this 89,585? I'll just repeat the calculation once again. It is 3,55,958 minus 1 lakh gives us 2,55,958. So this calculation, and then into 0.35. Now what is this 0.35? That is the tax. Okay, now here we don't do 1 minus t, it is tax savings, so you have to directly multiply it by the tax rate, that is 0.35. okay, so 3,55,958 minus 1 lakh is 2,55,958 into 0.35 gives us 9 lakh, 89,585. Now there is a small mistake over here, please don't use this. Okay, it is 89,585 into the present value. Now present value again would be 0.543. So 89,585 minus into 0.543 gives us 48,645. So please make this correction. Okay, it is 3,55,958 minus 1 lakh is 2,55,958 into 0.35, that is tax, gives us 89,585 into the present value. Okay, into the present value is 0.543 because this is also at the end of 5 years. So it is into 0.543 will give us 48,645. So 11,98,850 minus 54,300 minus 48,645 gives us 10,95,905. So this 10,95,905 is your present value of present cost of present value under buying alternative. So if you see, compare under leasing alternative, your present value is 10,28,723. Under buying alternative, your cost is 10,95,905. So if you see here, leasing is much cheaper because it is 10,28,000 than buying it, which comes to 10,95,000. So in this particular problem, you will go for a leasing alternative because the cost is less. So this is how you solve problem on leasing from a lessee's point of view. So I hope you're clear with this entire problem that we have solved. Try to go through the video. This problem is available on in the book also, so you can refer the book, that is Financial Management by Khan and Jain. Okay, in that on page this is edition number 5th edition, page number 25.12. okay, so it is example number 25. You can check it out. Okay, if you have any doubts, you can get back to me. I hope you have understood the entire problem on leasing from a lessee's point of view. Thank you guys, have a good day.